Alright, so in the previous videos we discussed how to do inventory adjustments. Went over the manual method, we went over the software method, and in both of those videos we assumed that we already knew all of our inventory costs. So in this video I'm going to dive deeper into how can we know that we know what our inventory costs are, and how can we create a little bit of an efficient system so that we don't drive ourselves crazy trying to figure out, well, how much does each of my individual SKUs cost. So this is just a simpler way to account, because especially if you import from overseas, your inventory costs are always changing, and you will drive yourself crazy. You'll spend more of your time trying to account for your inventory than you will actually sourcing and selling and creating new products. It can drive you insane. So here's kind of my process and philosophy behind calculating my inventory costs, and kind of trying to toggle between, okay, yes, I want a meaningful number for my inventory costs, but I also don't want to drive myself insane trying to get it down perfect to the penny. So here's kind of step one, is we need to categorize and separate our different costs. So first thing you do is go ahead and list all the costs that you have related to inventory. So some people have manufacturing costs and they also have kitting costs. Some people don't really have kitting costs. You just list everything you can think of down to duty, taxes, anything. And I want you to list all of those costs related to any kind of costs you have between the supplier and getting into Amazon's warehouse. List all of those costs down. Now the second thing I want you to do is to categorize all those costs. And we have two categories. You either have fixed unit costs, or you have dynamic unit costs. And what that means is, do each of these costs, the inventory costs, do they, from order to order, does it pretty much stay the same at the unit level, or does it dramatically shift? For example, manufacturing costs. Whether you order 500 or you order 600 of your widget, the manufacturing cost you pay is probably going to stay about the same. Obviously that will shift as you start ordering exponentially more units, then your unit costs will probably drop. But certain costs, like kitting costs, they'll charge you 25 cents or 75 cents per unit, and that stays the same every single order that you make. So those kind of costs would fall under fixed unit costs. Whereas something like freight, duty, those kind of costs, those will tend to shift dynamically from shipment to shipment. It will almost never stay exactly the same. If it is, great, you can lump your freight under fixed unit costs. But any of the costs that you have a really, really difficult time tying back down to the unit, generally these are costs that you pay per shipment rather than per unit. These are things that I would lump in as dynamic unit costs, or what I call bulk costs, because you generally are paying for these costs in bulk. So anyhow, go ahead and categorize all of your inventory costs across those two different categories. And what we're going to do is we're going to account for these two different categories differently. So in step two, this is how I suggest that you would account for your fixed unit costs. So first, you're going to add up all your fixed unit costs for each SKU. For some people, you might just have one fixed unit cost. For some people, you might have a few different fixed unit costs. What I want you to do is total all of those fixed unit costs up, and I want you to use this as your average cost moving forward. I'll explain what I mean by moving forward, and then what we're going to do is, as your fixed costs hit your bank account, so whether you pay suppliers, it's generally going to be in the form of the 30% down or the 70% down. As these fixed costs hit your bank account, I want you to categorize all of these purchases or these payments for fixed costs. I want you to categorize these to primary inventory. And so one thing to note here is, a lot of times my clients will pay their suppliers for fixed costs and for dynamic costs on the same PO. So you may pay for manufacturing and kitting on the same PO as you pay for freight. In which case, what you just need to do when you create that purchase order is you need to make separate line items. If you pay $10,000 for manufacturing and $2,000 for freight, you need to make two separate line items on that bill. $10,000 to primary inventory, and then the $2,000, I'll show you how to handle that in just a minute. So all fixed costs anything associated with fixed costs, we want to categorize that to primary inventory. And then what we're going to do is each month we're going to expense off the value of the inventory sold via manual journal. And you're going to use the average cost that you calculated in the first bullet point. So in the previous video, whether you were doing the manual way or using Inventory Lab, I want you to use the average cost from the fixed cost. Don't include dynamic costs in your average cost. So whenever you go to plug in your average cost in Inventory Lab, I want you to only use fixed costs. Or if you use the cost of goods sold calculator that I showed you in the previous video, I want you to only use average cost. I only want you to use fixed cost as your average cost. So this is how you're going to account for fixed costs. You're going to add up your fixed costs, turn it into your average cost, and that process will stay the same month in and month out. Now the next step, we're going to account for these other costs. So let's call it freight and duty, for example. These are what we're going to call bulk costs. They change dynamically from unit to unit. It's almost impossible to keep track of that. The first step in this process is I want you to determine how long that your inventory stays in stock on average. So what I find is most my clients, they buy inventory for about 2 months worth of stock or 3 months worth of stock, some just 1 month. Whatever the case is, determine the average amount of months that inventory will stay in stock. And then what I want you to do is, as these bulk costs hit your bank account or you create supplier bills, I want you to categorize these line items to an account in the chart of account called Capitalize Bulk Inventory Costs. And then what we're going to end up doing is each month we're going to do a manual journal where we're going to expense off a portion of these bulk costs. So take, for example, let's say you have duty and freight that equal $2,000, like my previous example. And let's say you stock inventory for 2 months at a time. What you're going to end up doing is take that $2,000 and you're going to expense $1,000 of it in month 1 and then $1,000 in month 2. So all you did was you took your bulk dynamic cost. Instead of breaking it down at a unit level, you take it as one lump sum, and then you break it across the average amount of months that your inventory stays in stock. So it's just a simpler, cleaner way to keep track of these dynamic costs without trying to break them down to the unit level. Because whenever you start having multiple shipments that start landing in, you're going to have a lot of different average costs and it's going to drive you insane. So just treat these bulk costs separately and expense them out across the number of months that your inventory tends to stay in stock. I'm actually going to show you in a separate video what that manual journal looks like for the bulk costs. Anyways, I'll finish up by saying here are some resources to help. In the course documents and resources section, I put a checklist for this process. I also, in the resources, I have a cost of goods sold calculator, which I referenced in the previous video. And then I also have a bulk cost calculator, and it has all the different instructions on how to handle it. So go check out those resources, and I'll see you in the next video.